Okay, everyone, I'll go ahead and introduce the next speaker and welcome you back from the break and to this next section of the webinar. During the next hour, about a 35-minute presentation followed by some Q&A, Gideon Laux of Advance Consulting will provide advice on how businesses can obtain more financing, talking through the pros and cons of approaching different investor types and walking through what businesses need to be more investor ready. Gideon leads Advance Consulting's impact finance work based out of the company's Nairobi office. And Advance Consulting itself is a business advisory firm that has been advising companies across Africa for 25 years and has raised funding for over 400 agribusinesses, including debt, equity, and grants. So they are very well placed to provide some capacity building in this forum. And I should also say that we have been partnered with Gideon and Advance Consulting for the last several months as they supported us to do some of the research for the landscaping study. So they were our partner on the landscape study. And I will now turn it over to Gideon to get started.
Fantastic. Thank you, Kristen. So in this segment, we're mostly going to be talking to the livestock businesses on the call, especially those fundraising. However, everyone else who's interested in this topic is very, very welcome to stick around and listen to the conversation. Also, as we go through the presentation, please don't forget to put your questions in the Q&A box. The earlier they come through, the more likely it is they will be answered because our team is looking at them as we go. So in this segment, we're going through mainly two things. So one is the types of funding and funders that may be relevant to you as a livestock business. Kristen and Arjun had already touched on this a little bit in the first part, but we'll go a little bit deeper just to make sure everyone is clear on what is available. And the second part is on the fundraising process. So step by step, what does it actually take for you as a livestock business to get funded? And then we're going to have a short Q&A session again at the end. So in this segment, we're going to look at mainly debt and equity in a bit more detail. We're also going to look briefly at what mezzanine is. And another funding instrument that could be available to you is grants, but we're not going to be covering this here. So at this stage, before we dive into it, it would be great to pull up the poll and see from everyone who is here, especially the businesses, what stage is your business at? And if you're looking to raise funding, how much funding are you looking to raise? Because that's going to affect what types of investors and instruments will be applicable to you. So let's leave that up for a few seconds for you to answer. And then we can look at the results. Here we go. All right, so there's quite an interesting mix. A lot of the business a little bit more early stage and looking for relatively on the smaller side of the ticket sizes. So that's great to keep in mind as we go through. So, one second. All right. Let's first look at debt. So debt is the most common funding type for companies across Africa, and that also applies to the livestock sector, as we've seen in the first presentation. A lot of that would be bank debt, but other investors can also offer different forms of debt. As I'm sure we're all aware, the common structure of debt is that you get money for a fixed period and you need to pay back with interest. That period can either be short-term. So for example, for working capital, if you're a trading company, and you're buying and selling goods to finance that buying until you get the money back from selling, that's working capital, and that's where usually a short-term loan can be the most appropriate funding instrument. For other investments, longer-term investments, such as building a new production facility, which would be a capital expenditure, maybe a long-term loan could be more applicable. Now, debt is not going to be the right instrument for everyone, but if you are a company that is a little bit further along and has positive operating cash flows, is ideally profitable, at least on the EBITDA level, earnings before interest, tax, depreciation, and amortization, and you can kind of predict your cash flow in the future so that the lender can have comfort that they will be repaid, then it might be a good instrument for you. Even better, if you have fixed assets, for example, buildings or land, or in some cases, movable assets such as trucks that you can pledge as collateral to secure the loan. Now, let's look a little bit at the pros and cons of debt as a funding instrument. So the good thing is that you retain ownership of your company. So you don't have to give out a share, and you don't have to have someone kind of coming in and joining your decision making. You retain full control. However, and actually one other pro is that usually debt is actually cheaper. You might say, no, debt is not cheap, but debt is really expensive. And that's true on the face value because you have to use your current cash flows to repay continuously. But actually, as we'll see in the equity section, in the long run, debt is cheaper than equity. Now, to the points that speak against debt, for early stage companies, especially the ones that don't have positive and stable cash flows yet, it may be very difficult to access. If you've tried to access a bank loan as an early stage company, you've either probably gotten a very small loan or you've been required to pledge collateral that even is maybe 130% of the loan that you're asking for. So that's quite difficult to access sometimes. And also, if you're not able to make the repayments, of course, you risk that your company will break and die because of that. That's not the case with equity necessarily. As I mentioned, yeah, there's a drain on cash flow in the early stages of the business because you do have to make those regular repayments. And we'll see that equity, in contrast to debt, may bring additional benefits in terms of the advice and additional connections that the investor might be willing to put in. Now, let's look a little bit at what lenders could be relevant to you as a livestock business. Now, these are taken from the study that was discussed before. And these are investors looking at Kenya as one of the countries. But the good news for those of you, I saw a Q&A question before about Tanzania, and I'm sure there are other people on the call that are not necessarily only based in Kenya. A lot of these, apart from the banks on the top row, a lot of the impact investors and DFIs also look at other markets in East Africa and Africa more broadly. So let's compare these different providers a little bit. So as we already mentioned, banks generally quite expensive interest rates, generally require very high collateral. So in this section, we're actually, and because most of you are already familiar with banks anyway, we want to focus a bit more on what it takes to get investment from impact investors and to some extent DFIs. So the benefit with impact investors and these other private investment funds that give debt, you may actually be able to access debt at an earlier stage. So they're a little bit more risk-taking. And depending on how they can be more flexible on the structures to actually allow you to access that earlier. In many cases, they can actually offer you better interest rates and better terms than banks. And especially even if the interest rate might not be much cheaper, although sometimes it is, at least on the structure, they can be more flexible. So, and many times the tenor of the loan, so the period for which you get the money, and you need to repay it is longer than for banks. And sometimes you get a longer grace period as well, where you don't have to repay the loan, at least not the principal of the loan, for let's say a couple of years for a long-term loan. Now, the other thing is that on top of the money that you get as a loan, sometimes these impact investors can come with what's called technical assistance facilities. So they can pay for you or for a service provider to provide some extra value to you, whether that's on measuring your impact or setting up an IT system internally that helps you manage your business better, or providing training to farmers that you work with, or providing training to some of your staff. So that's a good side benefit and should be factored into the overall cost and benefit analysis. One other example is that was not covered in the report, but it may also be available to some of you, is crowdfunding. So that is basically a website that allows individuals around the world to invest in your company, either giving you equity or debt. A lot of the time it is debt, but sometimes it's also equity, and sometimes it's also just grants. And if you have a really strong impact story, then you may be able to access that. So there's a little bit less about the financials and a lot more about your impact story. Now, DFIs, development finance institutions, as already covered in the first half of the webinar, these are really looking at larger ticket sizes. So based on the poll before, we don't need to spend too much time on these because they're not going to be relevant to the majority of you. But if, for these global DFIs, once you reach a stage where you're looking for at least 5 million or more in funding, then this could be an interesting option for you. And just to mention, compared to impact investors, DFIs tend to be a little bit more risk averse, and the processes can be even longer. But we'll get to process in a bit. Now, let's look at equity. Equity is, a well-known funding type. So when you're looking at news articles about big funding announcements of tech startups all over the world, usually they're talking about equity, and that's kind of the thing that gets the big headlines. But how can it be relevant to you? Now, of course, equity means that investors acquire an ownership stake in your business. And in order to get paid back, that's really important to remember, they need to be able to sell their stake to someone else, either back to you at some point or to another investor, or theoretically, if the company goes public on the stock exchange, that would be another way, but that's not very likely to happen for most livestock companies in Africa. Now, generally, equity goes through a number of stages. So usually you would not just get equity investment once, but if you're going to one of these professional equity investors, they would expect you to be planning to have various stages of fundraising. So that, for example, someone who gives you money at pre-seed stage, which would be the earliest stage usually, excuse me, would be able to potentially sell their stake to another investor in, let's say, the Series C or D round, which is several years later. Now let's look at when equity could be a good instrument for you. This is especially if you're not a profitable company yet, but you have very high growth plans, right? So equity investors, because they need to sell their stake to get their money back, they would expect you to really grow exponentially and be able to grow your business to a point where the stake that they bought is going to be much more valuable to be able to get their money back with a return. And of course, generally equity investors take a lot more risk because they invest in companies that are earlier stage, that are not yet profitable in many cases. They want to have, actually, they're expecting a higher return on investment than a lender. And that's actually that's the secret to why equity is more expensive than debt. It's because of that aspect of taking higher risk and expecting a higher return. So that's one of the cons, but let's look at the pros. You don't initially have to pay back this equity out of the cash flow of your business. So you can keep using the cash flow that you generate to keep growing your business and keep growing the value of the company for yourselves and for the investor. And in many cases, equity investors can bring in more than money. A lot of them get really involved in the business. They may take a board seat. They may connect you to experts or to buyers, or just generally spread the word about what you're doing to other investors, etc. So that can be quite beneficial. But on the other hand, if you have someone, an investor on your board, of course, they will also somehow enter into the decision-making process of your business. And some, as I mentioned, equity investors, some of them are quite focused on that high growth story, a little bit less so now than a few years ago, but still, you have to be sure that you align on the expectations with the investor that you take on board, because they might push you to take the company in a direction that you might not like. And that's the other thing. Once they are invested in you, it's very, very difficult to unwind that relationship. So it's really, some people compare it to a marriage in terms of the intensity and how much you're tied together. All right, and so let's look at a few options for equity investors that could be a fit. There are some of these you've already seen on a previous slide. So some of them actually do both debt and equity. But generally, there's a few different categories. You have the really technology-focused venture capital funds that need to see necessarily some tech element. That usually means software in your business. So if you're, for example, developing a digital solution to connect smallholder farmers with inputs or with the market, that could be a fit for someone like AgVenture and Novastar Ventures. Now, with the impact investors, just to be clear, the transition between venture capital and impact investor can be very fluid. So some of them will consider themselves in one category or the other, or maybe in both. But impact investors similarly can also come in at the early stage. They still would prefer some tech element, something that they believe makes your company scalable without continuously having to invest into heavy assets to be able to continue scaling. They also, of course, it's in the name, focused on impact. So that often means specific sectors, or in the case of livestock businesses, it usually means focusing on smallholder farmers or smallholder pastoralists in some form. And again, they can come with technical assistance facilities. Then again, DFIs, similar names on the slide again, and it's a similar story to before. Larger ticket sizes, a bit more risk averse. And then you also have private equity funds here on the bottom right corner, some examples that do invest in livestock businesses, but in the usual case, those would require a majority stake. They would actually want to take over your business typically and decide themselves how to grow it further. But that can be a solution to this exit problem, the fact that your earlier stage investors need a return, and so you may want to sell your company to one of these private equity funds once it's grown to that appropriate size. So let's very quickly also look at mezzanine. This is probably the least well-known of all of these funding types, but mezzanine just basically means it sits between debt and equity on the balance sheet. So that means it combines features of both equity and debt, meaning that usually you have some kind of ongoing repayment. You have an interest rate component, so you do pay interest over the period of the financing. But the structure can be more flexible. So you can, for example, have a structure where you make the main repayment at the end of the term instead of making small repayments all the way through. And because it kind of sits in terms of ranking below debt on the balance sheet, certainly below senior debt, that means it actually takes more risk, which means at the face value, initially, you may actually consider mezzanine a lot more expensive than debt, but it could still be cheaper than equity, and in the long run, and it may be a fit for you if you've reached kind of the limit of raising senior debt. So senior debt, there's certain ratios that lenders look at which point they won't be comfortable giving you more of that debt. And it could also be a good fit if you're not necessarily willing to give up a lot of the ownership of your company. So maybe you can structure it in such a way that the mezzanine investor still benefits from the upside. So that means if your company does well, they take a share of the profit or potentially a share of the revenue, and that's how they get an additional repayment that kind of helps them cover the risk that they're taking. So I think we've covered this. The only thing with mezzanine is that sometimes the structure can be a little bit more complex. So it's usually good to have an advisor who's familiar with these structures to kind of give you some insights on this. And just to also say, a lot of the investors previously mentioned, some of them can consider mezzanine deals. So for example, AgThrive is one of those examples. So now that we've covered the types of funding that might be available, let's look at the step-by-step guide on how you could access this investment. Keep in mind that here we're really looking at the impact investment funds and DFIs mainly, because they have a bit of a different process than the commercial banks. Commercial banks, their process is usually a little bit shorter, but mainly they just need you to have the right amount of collateral to be able to secure the loan. In the case of these impact investors and DFIs, because as we said, they're taking a little bit more of a risky position in your business than the commercial banks, they have quite a thorough, long process to step through to be able to access this funding. So generally, the way you start is by really identifying your funding needs. You need to be clear on what you need the funding for specifically. Are you, do you need short-term working capital to kind of buy some more goods to then keep in inventory and sell later on? Or do you need long-term capital to build a new production facility? Do you need to invest in technology, or do you need to build up your team over time for a new business opportunity? These are very different uses of the funding that you're asking for, and that's going to be a key thing to have clear before you start the process. Then you also need to figure out when you need to start raising the capital, and we'll go into that a little bit later. At that point, you kind of look at, based on your funding need and when you need the money, what funders could fit that need, what funders can give you the right funding instrument and can be ready in time to provide the funding that you need. Then you need to get the documents ready that the investors expect, and we'll go over those in a bit. And then you start the process of getting in touch with the investors. They will do an initial analysis, then there's some negotiation, due diligence. We'll cover all of that in a little bit. And then once you get the money, if you do, keep in mind that if you're a growing business, you probably will need to raise or will want to raise funding again. So it's always good to, as you close one fundraising, to already be thinking about the next one and to constantly be preparing for the next fundraising. So let's go into this in a bit more detail. So in terms of when you need the funding and what you need. So as I've already alluded to, it can take quite a long time, this process. So in total, it could take anywhere between 5 to even 18 months. And it's good to prepare for a longer process rather than expecting the money to be in tomorrow. I know that a lot of the time, for example, when companies reach out to us to help them with fundraising, they more or less need the money yesterday. But it's good to keep in mind that this process takes some time. A big part of that is actually getting the documents ready that you need. And then the investors have their own processes that will take anywhere between 3, 4 to even 12 months, depending on what type of investor you approach. So it's also good to be clear on that upfront. But basically, when do you need to be able to have the financing? You more or less need to do a financial projection. So you need to look at, based on the revenues and the costs that you have in your business and your current cash, when are you going to reach a situation where your cash falls below zero? Or if you're in the lucky position to be a profitable cash generating business, of course, then you should be thinking about, when do I want to make a certain investment into a, let's say, a new business line or something like that, that would require external funding. And in this entire process, when it comes to timing, as I mentioned, the investors have their own processes, and there isn't that much that you can do to accelerate those, other than being ready upfront with all the information that they will require, and also being ready in terms of the fundamentals of your business. So that's obviously something that needs to start much earlier than that point in time when you want to raise funding. But what we can look into in this webinar is the investor materials in a little bit. First, let's look at how to figure out what the right funding instrument is. We've already gone over them a little bit. So depending on what your use of funds is, working capital, capital expenditures, operating expenditures, that will lead to somehow different funding instruments that would be appropriate. So, for example, for working capital, again, generally a short-term loan would be the best approach. And then depending on whether you're a profitable cash-generating company, for CapEx, capital expenditures, you can raise debt, or maybe equity is more appropriate. Equity could be more appropriate, especially for new business line investments, things that are kind of more risky than expansion of your core business. So as you're kind of going through, and you can again use the advice of an advisor, or resources that we will also be sharing with the material after this webinar, to figure out, what is the right instrument for you, and then what investors can provide that. There are some online databases of investors and detailed information on ticket sizes, on funding instruments, etc., that you can use to figure that out. So compile the target list and really be targeted, because generally reaching out to just a whole bunch of investors that may or may not be relevant is not the best approach. The best approach is actually to somehow get a personal introduction to one of the investment team at the target investor. The investors generally have websites, or they have contact forms where they do receive pitches, but you have to also keep in mind that they receive hundreds, sometimes even each day, hundreds of pitches through those channels. So if you really want to stand out, it's important, to get your materials right, we'll go over that, but also to avoid the contact form and get a personal introduction. So finally, for the materials, really just very briefly overview. I mean, generally you need a financial model, which is a financial forecast that shows exactly what you want to invest in and how that is going to generate returns, revenue, and then returns from your business. It demonstrates what your funding need is specifically. So that is the breakdown into working capital. What kind of capital expenditure is that? A new production facility? Is it trucks? Is it land, etc.? And once you have that financial model, once you have the forecast, you would need something that is often called a business plan, which is generally just a write-up of your financial projection. So all the assumptions behind it, why do you think you can turn this funding into X amount of revenue or profit, and why you will be able to repay the investor, either through the repayment of the loan or through some sort of large growth of your business that will make it attractive to buyers. And then finally, when you are presenting to investors in person, it's good to also have a pitch deck where you present the narrative, where you really focus on the narrative. So this is, keep in mind that you're selling yourself. You're selling your business in some way, and you need to get the investors hooked. So actually the design of materials and the error-free nature of the materials is very important as you're preparing these. And then once you have these materials prepared, You also will need for later on in the process, you will need to set up some form of a data room. So that can usually be a Google Drive folder, a Box folder, Dropbox folder, whatever, where you store all the information, and some of it is listed on the slide that investors will ask for during the process later on. So it's good to have this ready up front, but when you're doing the initial outreach, don't already share all of that information. Just share, the pitch deck, and then in the next step, the financial model and business plan. You don't want to overwhelm investors with information up front. You just want to get them hooked, and then you go into the process later on. So here's an overview of the process, how it looks also from the side of the investor. So as I mentioned, you want to be introduced ideally, and you want to get a good contact at the investor. You want to send them a pitch deck probably, and as soon as possible get an initial meeting to explain the story of your business and why it's a good investment opportunity, and really focus on that narrative, focus also on the impact, very importantly, that your business has to get the investors interested. At that point, if they're interested, they will go into the initial analysis, request more information. Usually that's audited accounts upfront is very, very important. So if you don't have those ready yet, get started on completing those very quickly, because sometimes that can take quite a number of months to get those ready if you haven't done that before. Generally, then the investment team that is looking at your deal will present at a first approval stage. That usually, the processes are pretty similar for all of these impact investors and DFIs. So you have a first approval stage, maybe a second one, and then at some point you have a final approval stage. So these investment committees are sort of external bodies that provide oversight and the decision making for the investment team. So you need to put the investment team, so the associate or the analyst that is working with you on your deal, in the best position to be able to convince the investment committee. So you're actually a little bit on the same side at this stage of the process with the investment team, to be able to give them just the right information that they need to convince the investment committee. Once that has happened, if it's approved, then usually you will get a term sheet that is just a brief indicative summary of, for example, in the case of debt, it would be potentially the interest rate, certainly the amount that they're looking to give you, the tenor and things like that. And very important, once you have that, once you get initial terms, negotiate them, because there's usually always a little bit of room to negotiate, and you need to make sure that it's a fit for what you need before moving forward and spending a lot of time on this whole next step of the process, which is due diligence. Due diligence is just a usually a few months actually process. This could actually be the longest time of this entire process, where the investor is looking at, they've made the initial decision they want to finance you, but now they really just need to prove that there's no red flags, that there's nothing wrong with your business that's really going to throw the whole deal off course, or potentially damage the reputation of the investor if they give you money. And really, so they're looking at all the different things where risk could come up. That's financial aspects, legal, tax. If you're a technology company, you have some kind of production process, they will look into that. They will talk to some of your customers. Usually they will talk to some of your employees, your board members, if you have them, some of your senior management, some of your suppliers. And they will also look, very importantly, they will look into social, environmental, governance issues. So that could mean, if you're working with smallholder farmers, do they have a contract to work with you? If you have a production process and you have employees working there, are they, do they have the right safety equipment? Sometimes it's actually, even one missing hard hat in a production facility can raise red flags. So it's with these impact investors, and especially with the DFIs, it's extremely important. I can't stress it enough to tick all the boxes on this social environmental aspects. If you pass that, and that is a big deal if you've passed these rigorous due diligence processes, then they will take the deal back to the investment committee for final approval. Usually there's not much, unless there have been red flags raised, you wouldn't expect anything to go wrong at that stage, because they've already, they already like the deal, and they just want to make sure that there's, nothing standing in the way of going forward. At that point, you would then sign a final term sheet. So at that point, you're agreeing on the commercial terms of the deal, and you would not normally change those after that point. Because then in the next stage, lawyers would then come in and convert those commercial terms into legal agreements that are then binding. And then once you've signed those, then you're done, right? No, but don't celebrate too early, because you still have to potentially meet some steps before the money hits your account. So only celebrate when the money hits your account. We don't have time to cover that in detail, but generally between legal agreements and disbursement, there can still be some conditions that you have to meet to be able to get the money. Now, wow, that all sounds really long and hard, right? So why would you even go through this entire process? Let's go back to the beginning and why we're even talking about this. It's because, a lot of you have interacted with banks, but you've also experienced that bank loans tend to be expensive in terms of the interest rate. And there's also usually a limit. So the limit is usually given by the collateral that you have. So impact investors and DFIs can take more risk than banks and can give you more flexible terms. And once you've the good news is, once you've gone through this process and passed it, it's a vote of confidence to other investors. Let's say you've gone through a process with one of these impact investors, then another impact investor will look at it and already be more confident that you could pass their process more easily as well. So they'll be more willing to start a process with you, they'll look at it more favorably from the get-go, because also, as I said, investors talk to each other. So if you're in with one of them and they like you, they would then recommend you to others as well. So, and the other thing to keep in mind is that, as I said before, if you're just sending a pitch to an investor via the website, anecdotally, fewer than 5% of those actually get to the next stage or are even seriously considered. But if you follow all the steps that we've talked about today, and I'm happy to provide more detail if you reach out to me afterwards, you can really increase your chance of success by a lot. Maybe you can get up to 25, 30% in terms of the likelihood that you actually end up going through the process. So thank you very much at this point, and we're open to questions. And here's also my contact details on the page if you'd like to reach out to me afterwards. All right.
Thank you, Gideon. I do believe that a lot of the businesses here and even non-businesses have gotten key insights around the process of debt, equity, and the 9 funds raising. I believe that there's a few questions here, but I just wanted to group them based on the themes. One key one is around any specific advice that you may have for companies that are working with smallholder farmers, since a good chunk of participants within the livestock sector are smaller in size, and I would imagine that most of the funders you've listed there do not want to work directly with a very smallholder farmer. So do you have any particular insights on how to either support the farmers directly or how to work with the smallholder farmers to ensure that even they are able to access the funding?
Yeah, sure. Exactly. As you correctly said, these investors, also because of the ticket sizes that they look at, as smallholder farmers would not be a target for direct investment, but they do really love to support companies that work with smallholder farmers. So whether that means providing inputs to them, providing a source of offtake or market linkage for them, or advising them if it's a veterinary business. So as long as you're able to make a good business case out of working with smallholder farmers, they're very keen to support those kind of businesses. And in terms of advice on how to present such an opportunity and go through the investment process, as I mentioned, the social, environmental, and governance aspects of the investment process, especially of the due diligence process, are really key here. If you are able to kind of sign contracts and have a record of those contracts with your smallholder farmers, that's a big plus. If you're able to look at other social and environmental aspects, so for example, if we are doing a due diligence on behalf of an investor looking at these aspects, we would also look at things like disposal of hazardous chemicals, if they're, for example, using fertilizer or pesticides for production. Of course, in the livestock sector, animal welfare aspects, as we heard earlier, are extremely important. Usually, there's not such a big issue of that with smallholder farmers directly, but if you're, for example, in some cases, for example, buying goats from smallholder farmers, then what's important there is what you do with those goats after you have them, how are you treating them, things like that. Yeah, so I don't know if that answers the question, but happy to dive deeper if needed.
Thank you so much for that, Gideon. Another key theme that I see emerging within the questions is around a business can invest in forming the perfect pitch, and you have off-takers that those are guaranteed, but then when you do send, as you've said, there's about a 5% chance of being read by the funders. And a key tip that you've given is getting introductions to these investors. Given that not everyone has a network of DFIs on hand, how would you advise these businesses what can they do to get those introductions to the investors?
It would be very easy for me to say, contact me, because we have that network, but there are other ways, of course, as well. Yeah, so conferences can be quite useful. So if you're able to, and sometimes there's also sponsorship available for smaller companies or earlier stage companies to attend conferences. Some that might be relevant here is Kenya-based Sunculp Africa Summit, which happens this year. It's at the end of February in Nairobi. Another one would be what used to be called AgThrive and now the AFS Summit, Africa Food System Summit, that will be happening in Kigali this year. And there's other conferences out there. We can also share a list of those afterwards. Other points of contact would be ecosystem enablers or entrepreneur support partners. So these are companies that generally, sometimes it can even be free for you, and they can provide support to you in various aspects of your business. But one of those could be linking you to funding. And again, we can share a few examples of those afterwards. And the other thing is, in terms of the pitch, and as you mentioned, you target a 5% chance of being seen. What really increases the chance already, even if you're reaching out on the contact form or on the website, is if you have, as I said, a really well-designed and well-thought-through pitch. So it looks great. It's immediately visually attractive. That's quite important. But then also that the key elements that an investor wants to see are in that, right? Easily presented, not somehow hidden in a lot of text and things like that. But, what is your business about? How does it make money? How does it create impact? What are you looking for in terms of funding specifically? How are you going to use that funding? And how is that going to turn into cash flow that you can use to repay the investor? So if you've done your research, what the investor is looking for, and you target exactly in your pitch, you target exactly those requirements, that already gives you a huge leg up over the hundreds of pitches that would be coming into the investor's email inbox or contact form.
Great. Another key theme that I see emerging from the questions is around the debt and what is the typical interest range for debt. And then connected to that, we've seen currency really shifting over the last 1 year in terms of the exchange rate. So what does that mean for businesses that end up getting debt in hard currency? Is there any feedback that you've received, whether it's from businesses or the funders themselves, around the capacity of businesses to be able to repay hard currency type of debt?
Very, very important question. Thank you for that. So on the interest rate, you will see, I mean, if you approach your bank, you get the answer from them there, but it can easily be, 18% or something like that, depending on your business in Kenyan shillings. In terms of these impact investors and DFIs, they can often, as I said, offer somewhat lower interest rates. So a lot of them are international and will provide funding initially mainly in hard currency, so usually dollars. And the interest rate on dollars would usually, at the moment, the lowest, I mean, there are some that can go even lower, but let's say, to give a broad range, 8% plus on dollars, 8 to 12, 8 to 14, maybe, depending on who you approach on the dollar. Mezzanine investors will be more expensive than that, but as I mentioned, that's because they're taking a higher risk. Now, on the foreign exchange risk, which is obviously at the moment in Kenya a very big topic, there are more and more investors to respond to that current situation, or even the international investors are open to providing loans in local currency. And that would mean usually they would need to hedge it. So they would need to go to another provider that gives them a financial instrument that protects them against the foreign exchange risk. And that can be quite expensive. So if you're starting from let's say an 8% loan in US dollars, it can easily add 4 or 5% onto that if you can, if you're getting the loan in Kenyan shillings. So then you'll be paying, maybe 14%, something like that. Again, these are just examples. It will vary a lot on your specific business, the specific risk of your business, the stage of your business, what type of use of funds you have, whether it's the expansion of your existing business, which is usually seen as less risky than, for example, if you're investing in a completely new business line. So there are ways available to manage that currency risk. And again, happy to provide more details offline on that as well.
Thank you. And probably the final question, since we're right about the end of the session. This is more to do with the comments around innovation and climate change. What's the space of what do investors want to see when it comes to ensuring that the business is growing sustainably, but then also not, it's with livestock sector, it really depends on the business type. So do you have any experience or any thoughts around that, depending on your engagement with the investors?
Sure. It's true. A lot of those impact investors that we mentioned have, because of their impact focus, also look at climate change aspects. How are you, for example, helping farmers adapt to the effects of climate change? In some cases, if you have a solution, especially in the livestock sector, to mitigate climate change, that would be a big winner, right? Because that's a little bit more rare, or goes slightly against the narrative that is often told about the livestock sector. So those are definitely great aspects to have. And certainly, even if you're working in the beef or dairy value chains, it's probably a good idea to have some kind of plan for at least minimizing your carbon emissions. Yeah, and there are, since you mentioned innovation, I mean, there are of course innovative business models out there that can help you do that, whether it's around regenerative agriculture or other examples.
Thank you so much. I'll hand it over back to Arjun.
Well, thank you, Gideon, and thank you to everyone who stayed with us so far. I know it's a lot of content that we've tried to rush through in 2 hours, and we've barely scratched the surface. But we hope you found this informative and it's provoked some ideas. Shortly, as soon as we finish the webinar, we'll send out a brief survey, and we'd be really grateful if you spend a few minutes filling it in. It'll help us plan future sessions to be more useful to the audience. We'll also share the slides. There were quite a few questions about whether they would be shared. Yeah, we plan to, and they'll get to you within the next week or so. I'd like also to thank the speakers today, so Gideon, Chloe, and Shirley, but also the team behind the scenes, Alex, and Rita, and our Gatsby IT team, who worked really hard to make today's webinar happen. And if you're a livestock business listening in the beef value chain and you're actively looking to raise investment, reach out to Gatsby. We'd be happy to have a chat. If you're any other livestock business actively looking to raise investment, reach out to Kristen and AgThrive. She'd be happy to hear from you. I think for now, that's it. We thank you again for your time and for joining us today. And yes, hope you all have a good rest of the day. Thank you all. Bye.